This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Most investors think they only make money from shares when the share price goes up, but options can give investors more choices. If you own shares and expect a strong rise, you may simply hold the shares. If you are worried about a major fall, you may consider buying a protective put. And if you expect the shares to trade sideways, you may consider selling a covered call to generate income while you wait. In this video, we are going to walk through a practical example using the same share price all the way through. We'll look at how covered calls create income, how protective puts act like insurance, how to choose strike prices, and how the outcome changes depending on whether the share price rises, falls, or moves sideways. Can you use covered calls on every share? Before we get started, there's one important point to understand. Not every share listed on the stock market has options available to trade. Options are generally available on larger, more actively traded companies and many popular ETFs. Smaller companies often don't have an options market at all. That doesn't mean you should only invest in companies that have options. Many excellent long-term investments don't offer options, and that's perfectly fine. It simply means that if your plan is to generate extra income by selling covered calls, you'll need to choose shares or ETFs that actually have listed options. So think of options availability as another feature to consider, not the reason to buy an investment. Once you've confirmed a stock has an options market, then you can decide whether the covered call strategy is suitable for your investment goals. Let's keep this simple. Suppose you own 100 shares of company ABC. The current share price is $50. That means your shares are worth $5,000. You like the company long term, but over the next month, you are not sure it will move strongly higher. Maybe the chart shows support around $45 and resistance around $55. So you ask yourself a practical question. What is my outlook for this stock? If you expect a strong rise, you may simply hold the shares. If you expect a sideways market, you may sell a covered call. If you are worried about downside risk, you may buy a protective put. Before we go further, let's quickly refresh the difference between calls and puts. A call option gives the buyer the right to buy shares at a fixed strike price. A put option gives the buyer the right to sell shares at a fixed strike price. So calls and puts work in opposite directions. Call buyers usually benefit if the share price rises. Put buyers usually benefit if the share price falls. In this video, we are looking at two practical uses: selling a covered call to generate income and buying a protective put to protect against a major fall. Let's also refresh three important terms: in the money, at the money, and out of the money. These terms compare the option strike price with the current share price. Our share price is $50. For a call option, a strike price below $50 is in the money. A $50 call is at the money. And a strike price above $50 is out of the money. For put options, it works the opposite way. A put strike above $50 is in the money. A $50 put is at the money. And a put strike below $50 is out of the money. This is why calls and puts can be confusing at first. The same strike price can mean something different depending on whether you are looking at a call or a put. Now let's look at three different choices using the same stock. Choice 1, you simply hold the shares. There is no option premium. There is no extra income. There is no downside protection, but you keep all of the upside if the stock rises. Choice 2, you buy a protective put. You pay a premium. That premium is like an insurance cost. If the stock falls sharply, the put helps protect you. Choice 3, you sell a covered call, you receive premium income. That premium gives you some downside cushion, but your upside is capped if the stock rises above the strike price. Same stock, 3 different strategies. The right choice depends on your outlook. A covered call means selling a call option against shares you already own. The word covered simply means your obligation to sell is backed by your existing shares. You may also hear the term naked call. This is where an investor sells a call option without owning the underlying shares. Unlike a covered call, there are no shares available to deliver if the option is exercised. So, if the share price rises sharply, the seller may have to buy the shares at a much higher market price to meet their obligation, which means the potential losses can be extremely large. Because of that risk, many brokers either restrict naked calls or require experienced traders and significant margin before allowing the strategy. In this video, we're focusing on covered calls, where you already own the shares. For most long-term investors, this is the more appropriate and lower risk way to generate additional income from an existing portfolio. Let's look at a simple example. You own 100 shares of company ABC. The shares are trading at $50. You decide to sell a call option with a strike price of $55. The buyer pays you $2 per share for that option. Since one options contract usually covers 100 shares, you receive $200 in premium. That money is yours to keep. In return, you agree to sell your shares for $55 each if the option buyer chooses to exercise their right before the option expires. If the option buyer decides to exercise their option, you may be assigned. Assignment simply means your broker automatically sells your shares at the agreed strike price. You do not need to manually find the buyer. You do not need to arrange the sale yourself. The broker handles the process. In our example, if you are assigned, your 100 shares are sold at $55 each. You receive $5,500 from selling the shares, and you still keep the $200 premium. The important point is this: when you sell a covered call, you are receiving income up front, but you are also accepting that your shares may be sold at the strike price. Covered calls are often used when an investor expects a share to move sideways or rise slowly. Think back to support and resistance. If a share is trading at $50, support is around $45 and resistance is around $55. An investor may decide to sell a call near the resistance level. Why? Because if the stock stays below $55, the option may expire worthless. The investor keeps the shares, keeps the premium, and may be able to sell another covered call the next month. That is why covered calls are often described as generating income while you wait. Let's look at the first outcome. You own 100 shares at $50. You sell a $55 covered call. You receive $2 per share. That gives you $200 in premium. At expiration, the stock is trading at $53. The buyer has no reason to exercise the option. Why would they buy your shares for $55 when they can buy them in the market for $53? So the option expires worthless. You keep your shares. You keep the $200 premium, and you can decide whether to repeat the process next month. Now, suppose the stock rises to $60. The buyer exercises the option. You are assigned. Your shares are sold at the agreed strike price of $55. At first, that may feel frustrating. The stock is now worth $60, but you agreed to sell it for $55. However, you still made money. You gained $5 per share from $50 to $55. On 100 shares, that is $500. You also kept the $200 premium, so your total gain is $700. The trade-off is that your profit was capped above $55. That is the main risk of a covered call in a rising market. Now, suppose the stock falls to $45. You still keep the $200 premium, but your shares have fallen by $5 per share. On 100 shares, that is a $500 paper loss. The premium reduces the loss from $500 to $300. So the covered call cushions the fall, but it does not fully protect you. This is important. A covered call is mainly an income strategy. It is not full downside protection. If you want stronger protection against a major fall, you may need to look at protective puts. A protective put is different. With a protective put, you still own the shares, but you buy a put option to protect yourself if the share price falls. Think of it like insurance. You pay a premium, and in return, you have the right to sell your shares at a fixed price. In our example, the stock is trading at $50. You buy a $45 put. The put costs $1.50 per share. Since one options contract usually covers 100 shares, the cost is $150. That premium is your insurance cost. Now suppose the stock falls to $40. Without protection, your shares have fallen by $10 per share. On 100 shares, that is a $1,000 paper loss. But because you bought a $45 put, you have the right to sell your shares at $45. Your loss on the shares is limited to $5 per share. From $50 down to $45. That is a $500 loss. You also paid $150 for the put. So your total cost is $650. That is still a loss, but it is much smaller than the $1,000 loss you would have had without the put. Now suppose the stock stays around $50 or rises to $55. The put option may expire worthless. That can feel disappointing. But remember, insurance often feels wasted when nothing goes wrong. You paid $150 for protection. If the stock does not fall, you lose the premium, but you still own the shares and you still keep your upside. That is the trade-off. A put protects you from downside risk, but it costs money. So let's compare the two strategies. A covered call brings money in. You receive premium, but you limit your upside above the strike price. A protective put sends money out. You pay premium, but you protect yourself against a larger fall. So the question is not which strategy is better. The better question is, what problem are you trying to solve? If you expect sideways movement, covered calls may help generate income. If you are worried about a major fall, protective puts may help protect your downside. If you expect a strong rally, simply holding the shares may be the better choice. When choosing a covered call strike price, you are balancing income against upside. A strike close to the current share price usually pays more premium, but there is a higher chance your shares will be called away. A strike further above the current share price usually pays less premium, but it gives your shares more room to rise. Using our $50 stock example, you might see something like this. A $50 call may pay $3 per share. A $52.50 call may pay $2 per share. A $55 call may pay $1.40 per share. A $60 call may pay 45 cents per share. These are only example prices. Real option prices change constantly, but the pattern is important. The more room you give the stock to rise, the less premium you usually receive. Choosing a protective put is similar, but now you are balancing protection against cost. A put strike close to the current share price gives more protection, but it costs more. A put strike further below the current share price costs less, but it leaves you exposed to more downside before the protection begins. Using our $50 stock example, you might see something like this. A $50 put may cost $3 per share. A $47.50 put may cost $2 per share. A $45 put may cost $1.50 per share. A $40 put may cost 50 cents per share. Again, these are only example prices, but the principle matters. The more protection you want, the more you usually pay. Now let's walk through the basic process of selling a covered call. First, confirm you own at least 100 shares. Second, open the option chain for that stock. Third, choose your expiration date. For example, you might choose an option that expires about 1 month from now. Fourth, choose the call option strike price. In our example, that may be $55. Fifth, choose sell to open. This means you are opening a new option position by selling the call. Sixth, review the premium. If the premium is $2 per share, the total premium is $200. Seventh, review the obligation. You are agreeing to sell 100 shares at $55 if the option is exercised. Finally, check the order carefully before submitting it. Make sure you are selling one call contract, not buying one. Make sure the strike price is correct. Make sure the expiration date is correct. And make sure you understand what happens if you are assigned. Now, let's walk through the basic process of buying a protective put. First, confirm you own the shares you want to protect. Second, open the option chain for that stock. Third, choose your expiration date. Fourth, choose the put strike price. In our example, you might choose a $45 put. Fifth, choose buy to open. This means you are opening a new option position by buying the put. Sixth, review the premium. If the premium is $1.50 per share, the total cost is $150. Seventh, review what the put does. It gives you the right to sell 100 shares at $45 before expiration. Finally, check the order carefully before submitting it. Make sure you are buying a put, not selling one. Make sure the strike price is correct. Make sure the expiration date is correct. And make sure the cost makes sense for the protection you are receiving. Years ago, I had a trader friend who owned shares in a gold mining company. The share price moved sideways for months. Instead of getting frustrated, he used options to manage the position. Each month, he sold call options against the shares to generate income. Those were covered calls. He was being paid premium while the stock remained in a range. He also used put options to help protect his downside when he thought the stock might fall. So he was not just hoping the share price would move. He was actively managing the position. Some months, the calls expired worthless and he kept the premium. Some months, the puts gave him peace of mind when the share price looked weak. Eventually, the stock broke out of the range and the opportunity changed. But by then, he had collected premiums over many months while managing the risk. That does not mean this works with every stock, and it does not mean it is risk-free, but it shows how options can be used to create income and protection from shares you already own. Options are not set and forget. Markets change. So your outlook should be reviewed regularly. At the end of each month, ask yourself the same question again. What is my outlook for this stock? If the stock still looks sideways, you may consider another covered call. If the stock looks ready to break strongly higher, you may stop selling calls and allow the shares to run. If the stock looks vulnerable to a larger fall, you may consider a protective put. And if your original reason for owning the shares has changed, you may decide to sell the shares entirely. The option strategy should follow your investment view, not the other way around. Before using any option strategy, understand the risks. With covered calls, your upside is capped. If the stock rises sharply, you may miss some of the gain. With protective puts, the premium may expire worthless. If the stock does not fall, the insurance cost is lost, With both strategies, expiration matters. The option only lasts for a set period of time, and option prices can change quickly depending on volatility, time, and the share price. You also need to consider brokerage fees, tax rules, and whether options are suitable for your situation. Options can be useful tools, but they should never be used without understanding the trade-offs. Let's recap. If you own 100 shares, options can give you more choices. If you expect strong upside, you may simply hold the shares. If you expect sideways movement, you may sell a covered call to generate income. If you are worried about a major fall, you may buy a protective put to reduce downside risk. A covered call brings premium in, but caps your upside above the strike price. A protective put costs money, but helps protect you if the stock falls. The key is to start with your outlook, then choose the strategy that matches your goal. Options are not magic. They are tools. Used carefully, they can help you generate income, manage risk, and make your shares work harder. If you'd like to learn more about options investing, including practical strategies explained step by step, I've written a beginner-friendly guide called Profitable Stock Options Trading. You'll find a link in the description below. If you found this video helpful, please consider subscribing to the channel. It costs you nothing, but it really helps the channel grow and allows me to keep producing practical investing videos like this. Thanks for watching, and I'll see you in the next video.